Hello students of grade 10, my name is Ms. Neja Bamfield and I am your Principles of Business educator for today. Today our lesson will be continuing on the basis of insurance and assurance. Let us now turn our attention to the lesson objectives. At the end of this lesson, you should be able to explain the concept of risk pooling, explain how insurance facilitates trade, and describe the value of insurance coverage in lowering the risk associated with business. What is the concept of risk pooling? Risk pooling is the collection and management of financial resources so that large, unpredictable individual financial risks become predictable and are distributed among all members of the pool. Risk pooling can provide financial protection to households in the face of high health care costs. Risk pooling. Risk pooling is also known as health insurance, which is a group of persons contributing to a common pool, usually held by a third party. These funds are used to pay for all or part of the cost of providing a defined set of health services for members of the pool. In low and middle income countries, there are relatively high out-of-pocket expenditure for health care services. The different types of risk pooling mechanisms available. Number 1. National insurance systems. Funding comes from general revenues and medical coverage is provided to the entire population for a fixed set of services, that is, benefit packages. Services are delivered through a network of public and NGO providers. 2. Social health insurance systems. Funding comes from mandatory, earmarked payroll contributions from individuals and employers. Coverage is provided to contributors, usually in a phased manner. Services are provided based on a defined benefit package that can include immunization services. Additional subsidiaries may come from external assistance or earmarked taxes. Community-based health insurance schemes. These are generally non-profit prepayment plans for health care that are managed at the community level. Funding comes from prepayment into a pool fund, supplemented by government or donor resources. Coverage is provided to community members, and services are provided by NGOs or public facilities. Benefits are based on community preferences, and they may include preventative health care services such as immunization. Private health insurance. Funding of insurance premium comes from individuals who purchase coverage, out of the pocket, that is, on a voluntary basis. Coverage is limited to contributors and benefits are predefined and may include immunization. Services provision may be through a network of private providers. Question: in risk pooling, the funds are used to pay for all or part of the cost of providing a defined set of health services for members of the pool. True or false? If you've indicated true, this is correct. How does insurance facilitate trade? Commercial insurance protects small businesses owners from the damaging effects of financial liability arising from specific circumstances. It is important to carry at least 4 general types of insurance when engaging in trade and commerce. These insurances are liability insurance, property insurance, employment insurance, and auto insurance. Insurance is crucial to financial and organizational stability because liability can quickly lead a business and its owners into bankruptcy. Aspiring entrepreneurs should be aware of the importance of insurance in trade and commerce before starting their own business. The liability insurance. The importance of liability insurance stems from the range of financial risk that can arise from litigation, including legal action from customers, suppliers, or other business partners. Number 1, let us address the general liability insurance. The general liability insurance covers obligations resulting from negligence, personal injury, damage to property, and a host of other risks. Number 2, product liability insurance. Product liability insurance covers claims of injury or personal harm caused by defective or unsafe products. And number 3, errors and omission insurance protects against claims of malpractice for consultants, medical practitioners, and other specialists. To note, all of the policies mentioned prior are extremely important to small business owners with personal liability for business debts, as these types of risks can destroy personal credit if not properly covered. Property insurance. Number 1, commercial property. The commercial property insurance is a must for any business that owns a building. Number 2, renters insurance. The renters insurance is just as important for companies renting their space. Both types of policies cover the cost of fire, water, and hail damage, as well as vandalism and other criminal acts. Number 3, peril-specific policies. Peril-specific policies cover heightened risk faced by individual businesses, allowing them to exclude high-risk items from their all-risk policies. A company located in an area known for frequent tornadoes may exclude tornado damage from their all-risk policy and carry an additional peril-specific policy for tornado damage, for example, potentially resulting in a lower total cost. Employment-related insurance. Any business with employees should carry workers' compensation and unemployment insurance. Number 1, workers' compensation policies. Workers' compensation policies cover the cost of paying out workers' compensation claims in the event an employee is hurt on the job. This liability can be significant if employees are exposed to hazardous materials, operate dangerous machinery, or perform other dangerous activities. Unemployment insurance. The unemployment insurance covers the costs incurred as a result of a previous employee filing for unemployment benefits, in which case employers are liable to pay a portion of the filer's payouts. Note, Unexpected unemployment-related liability can eat away at companies' profits. It is important to carry insurance for these risks to ensure a steady and predictable expenditure. Question: Renters insurance cover the cost of fire, water, and electrical damage, as well as vandalism to vehicle and abuse on property. True or false? If you indicated false, that is correct. Renters insurance does not cover vandalism to vehicle and abuse on property. It covers all the other mentioned damages. Commercial auto insurance. If you use vehicles in your operations, it is important to carry commercial auto insurance policies. Commercial vehicles can include company cars, delivery trucks, construction vehicles, or other productive automobiles. Auto insurance. The auto insurance will cover the cost of repair or replacement in the case of an accident, as well as your liability if one of your vehicles causes damage to another person's property. It is important for productive vehicles to remain in operating condition at all times. So having a ready source of repair money is crucial to any business that relies on vehicles. Automobile insurance is also legally mandatory in almost every state and country. The value of insurance coverage in lowering the risk associated with business. What is insurance loss control? The term insurance loss control is a set of risk management practices designed to reduce the likelihood of a claim being made against an insurance policy. Loss control involves identifying the source of risk and is accompanied by either voluntary or required actions that a client or policyholder should undertake in order to reduce that risk. Key takeaways. Insurance loss control is a set of risk management practices designed to reduce the likelihood of claims being made against an insurance policy. Loss control involves identifying risk and is accompanied by voluntary or required actions a policyholder should undertake to reduce that risk. Policyholders may benefit from loss control programs through reduced premiums, while insurers can cut down their costs in the form of claims payouts. Understanding insurance loss control. Insurance loss control is a form of risk management that reduces the potential for losses in an insurance policy. This requires an assessment for a set of recommendations made by insurers to policyholders. The insurer may conduct a risk assessment before providing said coverage. Insurers may provide policyholders with incentives to be more risk averse. For example, an auto insurance company may reduce the premium for a policy if the driver takes a driver's education course. This means that the company will collect a smaller premium, but it also reduces the risk of a claim being filed by the insured because a trained driver is more likely to operate the vehicle in a way that is safer, making them less likely to get into an accident. Insurance companies may also require policyholders to take specific actions in order to reduce risk. Let us see why. For example, they may require a commercial building to install sprinkler systems to reduce the likelihood of fire damage, or they might require the installation of a security system in order to reduce the threat of theft. Insurance company may require policyholders to complete loss control programs to cut down on risk and reduce the chances of claims. Loss control programs benefit both policy owners and insurers. As mentioned above, policyholders may benefit from lower premiums, while insurers are able to cut down on their costs associated with having to pay out claims. Insurance companies identify activities that cause a claim to be filed by the insured and attempt to reduce the odds of these activities occurring so they don't have to pay out claims and dip into profits. Special consideration. Insurers may offer businesses customized loss control plans. Developing these plans involves a thorough examination of companies' operations and operational history. The examination is designed to show the cause of risk, such as unsafe working conditions. The plan then provides a step-by-step solution to mitigating that risk. For example, a factory may use loss control consultants to understand what causes workplace injuries. The consultants may find that a particular part of the manufacturing process currently involves placing workers in situations in which they are too close to machinery. A potential solution in this scenario is to increase the distance between the workers and the moving machinery or the moving parts of the machine. We have come to the end of our lesson for today. Now let us turn our attention to the exercise to be completed in your notebook. Question number 1. Define the term risk pooling in your own words. State in 50 words what is your understanding of risk pooling. Number 2. How does insurance loss control reduce claims? List 3 ways this is possible. Number 3. List 3 types of insurance that facilitate trade. Explain any one in 75 words. And number 4. What is the difference between risk and loss? Thank you for having me. My name is Nisha Bamfield, and it was nice being your facilitator for today.